Welcome to The Explainer. Today, we're digging into the latest massive move from one of finance's most famous contrarians, Michael Burry. And yep, he's taking aim at the absolute hottest sector on the planet, artificial intelligence. So it all kicked off with this pretty cryptic message. Now, Burry, if you don't know, is the investor immortalized in the film The Big Short for predicting the 2008 financial crisis. He has this habit of making these incredibly bold and, often controversial market calls. And this time, that cryptic message is pointing right at what he believes is the next huge bubble just waiting to pop. So what exactly is this game he's refusing to play? Well, the answer is hiding in plain sight, right in his firm's latest regulatory filing. It pulls back the curtain on a gigantic bet against the very stocks that have been pushing the market to unbelievable new heights. See, he's not just sitting this one out, he is actively betting it all comes crashing down. All right, first up, the Big Short's new bet. Let's really break down what the man who called the 2008 meltdown is targeting now. You heard that right. His firm, Scion Asset Management, has gone full contrarian. They've taken a huge position, not just against the market in general, but specifically against two of the biggest, brightest stars in the entire AI universe. I mean, he is shorting the AI revolution itself. Okay, so the big question is, why? Why is he so convinced this is a bubble? What is he seeing that so many other people are apparently missing? Let's take a look at the actual case for an AI bubble. Now, this is where it gets really, really interesting. Look at the sheer concentration of this bet. These regulatory filings show that something like 80% of his fund's entire reported portfolio is made up of short positions. We're talking specifically about put options, which are basically just bets that a stock's price is going to fall against just two companies, Nvidia and Palantir. This isn't a hedge. This is an all-in move. And the bet itself, it carries this just staggering headline number, a notional value of over $1 billion. To break that down for you, that's about $912 million against the data analytics firm Palantir, and another $186 million against the undisputed king of AI chips, Nvidia. But, and this is super important to understand, we have to talk about that number. Notional value is not the amount of cash he's actually put on the table. Think of it as the total value of the stock he's betting against. The real amount he paid for these put options, the premium, is much, much smaller. We just don't know the exact cost because it's not in the filing. And man, he is targeting absolute giants here. Nvidia recently became one of just a handful of companies in history to blast past a $1.5 trillion valuation. It's insane. And then there's Palantir, a huge favorite among retail traders, which has seen its stock soar an unbelievable 169% just this year. So Burry is basically betting against pure, unadulterated momentum. You know, for him, this all feels like déjà vu. He sees a really clear parallel to history. Burry's been hinting that this whole AI frenzy looks just like the wild overinvestment we saw in fiber optic cables way back during the dot-com bubble. The theory is that, just like back then, tons of money is just flooding into the so-called picks and shovels of the revolution. The chips, the infrastructure, long before anyone has proven out the long-term profitable uses. And remember, a whole lot of those fiber companies went straight to zero. But here's the thing. For Burry, this isn't just about AI. That's really just the most obvious symptom of a much, much larger problem he's been screaming about for years. He truly believes the entire market is built on a foundation of sand. He calls it the everything bubble. The idea is pretty simple, but scary. For over a decade, he says, central banks have just been pumping trillions and trillions of dollars into the financial system, keeping interest rates at rock bottom. And what's the result? Well, it's artificially inflated the price of pretty much every asset you can think of. Stocks, bonds, real estate, crypto, all at the exact same time. And this is where his critique of passive investing comes in. And it's brilliant, really. Think about it. Trillions of dollars are just flowing into index funds like the S&P 500. Well, that money has to go somewhere. It automatically buys the biggest companies in the index, like Nvidia, so their prices get pushed higher and higher, not because they're doing better, but simply because they're already huge. It creates this massive disconnect from reality. And all of this leads to his most famous analogy. The market has become a crowded theater with a teeny tiny exit door. Everyone's rushing in, having a great time, but when anyone eventually yells fire, the stampede to sell is going to be absolute chaos. It'll be destructive because there just won't be enough buyers on the other side to handle the panic. And look, there are numbers that actually back this view up. Take the Buffett indicator. It compares the total value of the stock market to the country's GDP. Not long ago, it blew way past its peak from the 1999 dot-com bubble. And Warren Buffett himself once said that when this ratio gets close to 200%, you are, anti-quote, playing with fire. Okay, but as compelling as all that sounds, there's a very powerful counter-argument to Burry's big bet. And it all comes down to one critical factor that every single trader learns the hard way: timing. I mean, just look at his track record. Even with his legendary 2008 call on the housing market, he was about 2 years early. He had to sit through massive losses on paper and deal with furious investors before he was finally proven right. And more recently, his famous one-word sell tweet back in January 2023, yeah, that came right before the market took off on a massive rally. This sarcastic comment from a user on Wall Street Bets just captures the market skepticism perfectly. The feeling is that Burry has a reputation for being a perma-bear, someone who is always predicting a crash. And hey, if you predict a hurricane every single day, you're going to be right eventually, right? And this brings us right back to that famous exchange from the movie The Big Short. When you're trading options, which is exactly what Burry is doing, being too early is basically the same thing as being wrong, because those options, they have an expiration date, and if the market doesn't crash before they expire, they become totally worthless. Poof! And that really leads to one of the oldest and truest warnings on Wall Street. The market can stay irrational a lot longer than you can stay solvent. Even if your entire thesis is 100% correct, the market's crazy momentum can last so long that it wipes you out completely before you ever get to say, "I told you so." So, after all that, what does this actually mean for you? Let's try to boil this all down and figure out the key takeaways from this epic clash between a legendary bear and a totally euphoric market. Okay, so what this whole situation really exposes are the powerful, kind of hidden forces that are shaping the market right now. First, you got this hidden risk of index concentration, where just a few gigantic stocks are literally pulling everything else up with them. Second, it's that classic battle between a real technological revolution and a speculative mania. And finally, it's that brutal lesson on timing. Being right on the idea is only half the battle. You have to be right at the right time. So we'll leave you with Burry's own analogy as a final thought. Whether he turns out to be right or wrong this time, his billion-dollar bet forces every single one of us to ask a really critical question. If the market really is a crowded theater, have you thought about your own exit strategy for when the show is over?